I'm Jessamine Norton. I'm the Chief Investment Officer at Spinnaker Trust. Welcome to our first half market review and outlook. The S&P 500 is up a modest 1.2% for the year at the halfway point. The second quarter in particular traded in a very tight band until the news of Greek unfolding happened at the end of the quarter. To recap the year thus far, January started with the markets in deflation mode. Thanks to a fairly positive jobs report out of the US at the end of January, the markets abruptly switched gears and started to anticipate a Fed rate hike. Case in point, the financial sector made an abrupt change during the second quarter. It started to perform well in anticipation of the Fed rate hike after having been a drag on markets for the past year. Year to date for the US market, the best performing sectors have been consumer discretionary and healthcare, while the worst performing sectors have been utilities and energy. International equity markets handedly outperformed US markets during the first half of the year. In fact, they had a historic first quarter in terms of relative performance, the best since 1998. Globally, the Japanese Nikkei has led the charge, and it's the best performing country and/or region this year. The European countries, even after this Greece debacle, are the second best performing group, followed by emerging markets, and the US is the worst performer of the major asset classes. Shifting to the fixed income market, the Barclays Aggregate Index fell by 1.7% during the second quarter, which is its worst performance in one quarter since 1981. US long bonds fell by about 8%. In the US, a series of surprisingly positive economic developments have put the investing public on what we like to call Fed watch. This positive economic data means that the investing public expects the Federal Reserve in the US to hike interest rates this year. Consensus expects that rates will go up for the first time in December. The Spinnaker investment portfolios are positioned for an interest rate hike, which means that our portfolios will outperform if and when rates rise. So we wanted to take a few minutes to talk about the situation in Greece, which we're calling the ultimate game of chicken. We're sure you've heard a lot about Greece lately and seen the events on the news and asked yourself, why does this matter? Why is this getting coverage? Greece is 0.3% of global GDP. Surely this can't matter to me. You're right. Greece is a very small and inconsequential country on its own. However, it's part of the European Union, and this will set a precedence for weaker countries on a go-forward basis. It should be noted that as a client of Spinnaker, you have no direct Greek exposure in your portfolios, neither equities or fixed income. However, we do have European exposure, and the fear in those markets is that the peripheral countries like Portugal, Spain, and Italy will be incentivized to start pushing the envelope with the ECB themselves. Unlike the last uprising in 2011, this time Greek debt is largely owned only by the ECB and the IMF. Global banks really aren't on the hook. We find the timing of this Greece flare-up to be quite unfortunate because we've been very constructive on the Eurozone economy and we've seen real turnaround and improvement there. A bit of inflation has been recorded, which is a good thing, and manufacturing indices have improved. And we still believe that the ECB is committed to its quantitative easing program. We believe that the euro will depreciate against the dollar over the next 12 months. Since the financial crisis in 2008 and 2009, we've observed that investors have flocked to perceived safe haven investments. These include investments in the fixed income market and also in the equity market. The popularity of these investments have driven valuations to very high and unattractive levels. For the bond market, bond mutual fund and ETF assets under management are now 25% of the GDP of the US. This is twice the level that we saw in 2007. Overall, fixed income trading and liquidity has decreased significantly since 2005. And it should be noted that we've seen a large influx of assets into the fixed income market, largely from 2009 to 2012. Our research partner, Empirical Research, has observed that most of this money came into the market when the 10-year Treasury yield was less than 3%. The 10-year Treasury yield today is at about 2.3% and will inevitably go to 3% in the next year or two. When this happens, we expect that these investors will take their losses and move on. And this, of course, will be quite bad for the bond market. As a client of Spinnaker, your fixed income portfolio is quite short in duration, which means that it's much less sensitive to interest rate moves. And further, almost all of our portfolio is exposed to corporate debt instead of government debt. We've definitely taken the safe route with our fixed income allocations. This phenomenon applies to the US equity market as well. we've observed that the 75 highest yielding stocks in the S&P 500 are trading at an 18% premium on a PE basis to the overall market. Yield-seeking sectors like consumer staples and utilities are trading at large premiums to their historical valuations. In contrast, technology stocks are trading at a 20% discount to their historical averages, and financial stocks are trading at a large discount on a price-to-book value. In conclusion, we expect a choppy and volatile summer as the situation in Greece evolves. And of course, the markets will be moved by any developments that come out of the Fed as it pertains to rate hikes at the end of the year. However, we believe that earnings estimates are too low across the globe and also in the US, and we expect a very strong fourth quarter to end the year. Thanks to listening to our market review and outlook, and we'll see you in October.